안녕하세요. Thank you so much for joining us today. It's a little bit colder outside than I'm used to coming from Singapore, but it's very pleasant to be here. So for 2023, we have our Playing It Safe theme. Obviously, last year was a very challenging year for all investors around the world. So the question is, how do we turn that into something that's more positive for 2023? Well, before we do that, let's just have a quick look backwards. Oops. Okay, there we go. So this is what we experienced last year. Okay, so you can see pretty much there was nowhere to hide. We were overweight energy stocks and energy, so that helped us to some degree. But at the end of the day, you can see the sea of light grey on this chart, or red as we're more used to seeing it, across equities and bonds, and obviously the dollar was strong as well. Now, we know this, but what we may not know is how can we put that year in context relative to the last 150 years? And that's what this chart does. Okay? So basically what this shows is over the past 150 years, the calendar year returns of the US stock market on the x-axis and of the bond market on the y-axis. Okay? So this is basically, each dot represents 1 year. And you can see, so let's see where we are. 2022, so this is us last year. Okay, so this was the worst performance of the US 10-year government bond in the last 150 years. Right? So that's the first point. Second point is, it wasn't great from an equity market perspective. It wasn't at extremes, as we saw here, but it was challenging from a stock market perspective as well. Now, if I was to look at this, I'd say, which is the worst year in the past 150 years? I would be split between last year and 1931. 1931, obviously the bond performance was negative, but a lot less negative, but the equity market was pretty horrendous. So maybe I'd rank it number 2 out of the last 150 years. So we experienced history. Does that make you feel better? No, probably not. Okay? What it does mean, though, is highly unlikely to be replicated in 2023. Okay, so we think this year is going to be a better year for investors. We don't think it's going to be without challenges, right? So there are definitely going to be challenges, and we'll talk about those. But we do think it's going to be a better year for us. Okay, so, oops, gone one too far. So this is our 2023 outlook in one picture. So let's just start about how we think about building portfolios. So what we think about here is, this is your foundation. This is what you should be looking to do to go through the economic cycle, to have a diversified foundation that will stay with you for the long run. What we have on top is what we call opportunistic. So short-term ideas that may give you different access to things that are a bit more exciting, but they shouldn't be your foundation. Your foundation has to include equities, bonds, and cash, and maybe gold as well, some diversified allocation, right? That's the starting point for building a portfolio. I think we often get bought into different stories at the top of this chart and get focused on those before we build the foundation, which we think is the wrong way to do things. So, for 2023, what does our foundation? I'll spend more time on foundation than opportunistic, but you can talk to your relationship manager about opportunistic. So, 4 things. So the SAFE, what does SAFE stand for? Secure your yield. Yields are higher today than they have been over the course of the past 24, 36 months, we should be securing our yield for the long term. We think yields are coming lower, so secure them now. Secondly, allocate to long-time value. I could have had the A as Asia, because in bonds and equities, we think Asia is where the value is. Thirdly, fortify against surprises. We expect a recession in the US this year, right? So that's not going to be pleasant. History suggests it's not going to be pleasant, despite the strong performance we've seen over the past 2 or 3 months for equity markets generally. So we should be having allocations to gold, cash in our portfolios. Cash as much, yes, yields are higher, but also give you dry powder to invest as markets come lower, okay? In the equity space in particular. And expand beyond the traditional, so private assets or liquid alternatives, which again, you can talk to your relationship manager about. We won't go into much detail there today. So that's the safe environment, safe portfolio, foundation portfolio that we're talking about for 2023. Okay, so Ryan mentioned in his introduction, I was here in July talking to you about things, and I used exactly the same chart, okay, as this one, but it's obviously been updated. When I was here in July, we were saying, when things are dark blue, they mean they're flashing red, they're high risk of a recession. When they're light gray, it suggests probably not a recession. As we went through the last 12 months, more and more has turned dark blue, i.e. signaling that a recession is likely. So whether you're looking at consumer spending, business confidence, and most importantly, in my view at least, the yield curves, where long-term yields are now lower than short-term yields. That means markets are saying that the US Federal Reserve has hiked interest rates too much already and will be forced at some point to cut, we believe, in the second half of this year. But they're still hiking. They meet this week. Consensus is around a 25 basis point hike, risk of a 50 basis point rate hike, but they're still hiking. They've hiked too much and they're still hiking. We think that means there's going to be a recession this year. Okay? Areas that aren't flashing red at the moment, labor market. Labor market is still incredibly strong, but that's just encouraging the Fed to tighten policy even more. Okay, so they're focused on backward-looking indicators, whether it be inflation, by definition, historical backward-looking, because it looks at the change in prices from today from 12 months ago. Labor market is also a lagging indicator as well. So they're hiking based on backward-looking data. The positive story is China. Right? So we were looking at around 4.5% growth in the Chinese economy this year when we wrote the 2023 outlook. That was based on an assumption that mobility restrictions would be eased in the second quarter of this year. Now, obviously, mobility restrictions are already eased. As I saw when I came through the airport yesterday, there's indications of what the Chinese people have to do differently to me to get access to the country because people are worried about a COVID spike. Okay? But people are traveling. Chinese New Year, we'll get a lot of data coming out of that of just how much people are traveling within the borders of China. That is going to lead to stronger consumer spending than we thought. So 5.5% growth this year is quite possible. Some are even saying 6%. We would not go that strong because we think the export environment, based on what's going on in the US and in Europe, will be weak. But the domestic demand should be very positive. So, very different stage of the cycle. US decelerating into recession. China, not booming would be a strong word, but performing strongly, growing strongly. Okay, so what does this all mean for investments? This is effectively the same data I showed earlier for the bond returns in the US over the course of the last 150 years. So it's a distribution of bond returns. So the red one is 2022, right? The worst, as we discussed, the worst on record. What this chart will show in a minute is what happened after the other three extreme losses for the 10-year government bond yield. So you can see that one was significantly positive, one was slightly positive, and the other one was very, very positive, right? So we've never had a performance of worse than negative 10% in the US government bond yield and not delivered positive returns the year after, right? So if you factor in our view that we're going to have a recession, we're going to get interest rate cuts, you factor in this historical perspective, we think it makes a compelling argument for investing in bonds, securing your yield, right? So those are the reasons really why we think bonds in this environment in particular are very attractive. Now, how has market priced? Has markets priced this already? Well, this shows you bond yields in different areas of the bond market. So the gray bar, is the history of the last 13 years. The light blue line is end 2021, and the dark blue line is end 2022. And you see, as we know, bond yields went up, bond prices went down sharply last year. But you can see in many cases, we're very close towards the top end of the range of the past 13 years. Again, factoring in everything that we've just talked about. Markets have not priced in much lower yields yet, in our opinion. So, now, where do we prefer? So our preference is Asia US dollar bonds. The reason for this is twofold. Firstly, we think over 6% yield for an asset class that has very high credit quality, so around 85% of this asset class is investment grade in nature, is very attractive, right? And if you look at spreads or the yield here versus the same asset class in the US, yields are significantly higher. Secondly, in the US, we see a recession happening, but in China, which is around 50% of this asset class, we expect the recovery to come through. That should support cash flows, that should support earnings, and that should make debt sustainability easier going forward. And actually, if I was to add a third factor, people are worried about the property sector in China, of course, but actually we're seeing regulatory easing in China from the regulatory front. So all of these, in our view, add to the view that Asian US dollar bonds are a great place to invest from a bond investment perspective at the moment. Okay, let's move on to equities. So I hate being underweight equities. Now, why do I hate being underweight equities? Well, pure maths tells us equities outperform 2/3 of the time. So if I'm underweight equities, I'm betting against history. I'm betting against the odds, right? I'm twice as likely to be wrong as I am right. Just looking, if you don't take a look at what's going on in the world, I'm twice as likely to be wrong than I am right. So why are we underweight equities? Well, 3 reasons. We expect a recession. So we've never avoided a recession when the yield curve inversion happens. We've never avoided a recession historically, right? So that's always happened. Sometimes it takes more than a year to happen, so that's the risk. It could take longer than we expect, but it's all, yield curve inversion has historically always ended in recession. Secondly, equities have never bottomed before the recession starts. They always bottom during a recession. And third, as this chart shows, during recessions, unsurprisingly, companies earn less money. So this is obviously the global financial crisis, a little bit extreme, right? Down 30, 40% earnings. This is COVID. So the question is how far, not whether, but how far earnings will fall this year, in our opinion. Market's still pricing for earnings to go up very marginally. So against that backdrop, we still think there's one leg lower for US equities. Okay? So we would not be chasing this rally. And if you read our publications, the Weekly and Market View last week made exactly this point, saying markets are all pointing towards the consensus seems to be to a soft landing in the US. And we've got the Fed meeting this week. So our view is that that soft landing is unlikely to be achieved, and therefore there's downside risks. Within equities, we have a strong preference for Asia. So you've heard the macro story, you've heard the earnings and cash flow story. I guess the point here is saying that valuations are not stretched. If they're anything, they're slightly cheap, right? So relative to the rest of the world, we're in a much better stage of the economic cycle. And again, that is not priced. It's getting priced pretty quickly. Markets obviously done very well since the start of the year, particularly in Asia, particularly in China. But overall, it's still not expensive, and if anything, it's slightly cheap relative to the rest of the world. Okay, so from our perspective, Asia still is the best place to be within equities. Now, what is this chart? So I guess let's start from the way that we think about things. So you can invest for income or you can invest for capital growth, right? Neither is right or wrong. At different stages of our lives, we might do different things. So when we get older, we might think more about income. When we're younger, we might think more about growth. But that's not a blanket right thing for everybody, because some people, if you're extremely wealthy in your 80s, you might be thinking about your legacy. What are you going to do with what's going to happen to your money after you pass from this world? But if we just look at it from a pure investment style perspective, which would we prefer today? We prefer income over growth, right? And the reason for this is obviously equities we are not overly positive on, and this have a much higher allocation to bonds, right? So multi-asset income strategies, by their very nature, invest more into bonds, okay? Secondly, if you look at the yield on this asset class, or this style of investing, so if we go back to mid-2021, we were struggling to get 4% yield. Now we can get 6% yield. And we don't think we're going to be able to get 6% yield for long, because we think prices will go up and yields will come down. So we prefer multi-asset income approach to investing in this environment. It's a great way to build a foundation portfolio, actually, because it's by nature diversified. Okay? So that's just a note on multi-asset income. So a quick summary before I just talk a little bit about FX before I wrap up. So obviously we are underweight equities with an overweight to Asia ex-Japan. We have a preference for both bonds, but with a particular focus again on Asia. Okay, we shouldn't forget cash and gold are areas that we should be allocating to as well. Gold typically does well. It's done very well so far this year, of course, so we may see some short-term weakness in gold, but gold has a good historical diversifying properties for investors, and as I said, cash can be used as dry powder to buy into markets if and when they weaken. So we think having an allocation to cash also makes sense. Okay, last slide. This is our view on the dollar, is that we think the dollar is going to weaken in 2023. It has weakened significantly already. So in the short term, we believe we will see a bounce, actually, because we think the Fed this week will be more hawkish than markets are anticipating. But for the full year, we think the dollar is going to weaken for two reasons. One, as I mentioned earlier, we see the Fed pivoting towards lower interest rates. Therefore, interest rate differentials will, over time, move more in favor of non-US dollar currencies. okay? The ECB, actually, the environment in Europe has been much better than anticipated with gas prices coming down. The economy is going to be less weak than expected. The ECB is probably going to be more hawkish than expected, so that probably exacerbates that trend. The second thing is, if we look at the US dollar from a valuation perspective, it's very, very expensive. So this is what we call the real effective exchange rate. It's basically a trade-rated exchange rate. And we are back close to levels we saw last in the mid-80s. I wasn't even at university in the mid-80s, right? So the dollar is very expensive, right? So we think some normalization of those valuations is likely as well. Okay, with that, that's all I have for you today. Thank you so much for your attention and your time, and I wish you a pleasant rest of the session. 감사합니다.